recording. All right, guys. Hello, guys. This is Vinit from Edge-Forex, and today is the 25th of August, 2025. And a lot has happened over the last week or so. Fed came out and gave a hint that, hey, they're open for cutting the rates going forward as long as the data is aligned. And there's a lot going to be happening this coming week, the week we are in now, which will drive the Fed to either, they're definitely not going to raise the rates. That's for sure. It's either they are going to keep it as is or they're going to lower the rates. And a lot of data that is coming out this week is going to drive that decision. So on Monday, we are going to get new home sales on Monday, where when it comes to new home sales, that could be existing home sales, that could be the homes that are not yet built, or could be the homes that are partially built. As long as the contract is signed, it is considered as a new home sale. So let's see how the previous month actually looked. So the last month, there were 627,000 new home sales contracts signed, which was 6.6% lower from the month before, so from June. So that doesn't bode well for the housing market. And also, the inventories are sitting highest since 2007, which is a 10-month supply, again, which is really, really, really high. And because of high inventory, because of low demand, the prices are coming down. So right now, the median price or an average price for the house is $401,000, almost $402,000, which is also declining. So again, it's demand and supply situation. If there's too much supply, the demand is lower, the prices drop. Okay. So now, if the new homes, if the coming month, if the past month, the sales is higher or shows strength, that means consumers are willing to borrow despite of the higher rates. Because right now, mortgage rates are sitting very, very high, say over 6% for the long-term mortgage, which is high as compared to the last decade or decade and a half. Okay, if the prices they sag, that means if there is not enough demand for the housing, that means the housing prices is going to go lower, and then everybody's going to be asking for Feds to cut the short-term interest rates. Because as I explained to you guys before, the only thing Fed has control over is the short-term rate. And then because they are lowering short-term rates, telling the market that, hey, there is risk involved, because now people are going to do reckless things that will lead into inflation and more debt, and that rises the long-term rates. Man, with the long-term rates, because the mortgages are tied to 10-year treasuries, they get higher, and the mortgage, instead of going lower, they go higher. And that is something people do not understand when they are expecting Fed to lower the interest rates. It's a dichotomy, guys. It's something that I've spoken again and again, that market is making a huge mistake. Not market, the Fed. Market is always right, guys. Market is reactionary by the decision that is made by the participants. Right now, Fed is the biggest participant in the market, because one decision that Fed is going to make, which is either holding the interest rate steady or lowering them, is driving everything, all the volatility in the market. Now, on Tuesday, we are going to come out with the durable goods orders. So that is the big ticket items that last you a long time, like cars, like appliances, like airplanes, trains, buses. So that is the durable good orders that tells you how much businesses are investing and households are willing to spend on big ticket items. So June's report showed a really wild swing. So the headline orders in June fell 9.3% after a May surge. The orders, the surge in May was because everybody wanted to front run the tariffs. So they're saying, hey, let's order before the prices rise or before the tariffs are finalized and are put into effect. But in June, then everything dropped because of the trade war, because of the tariff wars. Then a lot of countries were retaliating and saying that, hey, because of Trump, because of the tariffs, we are not going to buy these big ticket items, especially big airplanes and defense equipment from the U.S. So that had a huge effect on the big ticket items that were being sold by the United States to the rest of the world. Okay, so now a strong number. What does that mean? That means firms are still investing in the equipment and machinery, reassuring investors about the growth. Okay, so hey, everything is fine, nothing to worry about. Okay, no need to drop the rates, keep everything steady because everything is looking good. But a weak print is going to spark concerns that hey, everything is slowing down. Then it's going to feed into the bond rallies and dovish expectations. In other words, demanding rate cuts again is going to be a mistake. Again, consumer confidence in July, it rose to 97.82, but expectations stayed under 80 for the sixth straight month. So job availability also fell to its lowest since 2021. So now, on one hand, inflation expectations are easing, but on the other hand, Fed is coming out and saying that, hey, he is expecting higher inflation rate, at least for the short term. And I don't see how inflation is going to be short term if the tariffs are going to be a permanent fixture in the equation. Unless the tariffs are going to be short term, yes, I agree. Yes, inflation is going to be short term. In other words, inflation is going to be transitory, but that I don't think that is going to be the case. So if a consumer confidence improves, it reassures markets that, hey, spending will hold up, which will support stock markets and the yields. If it weakens, investors are going to rotate into safer assets, start pushing harder for Fed to ease and do quantitative easing. In other words, to print money. Wednesday is going to be a huge, huge, huge test for these AI companies, right? I've been screaming from the rooftop that these AI companies, this AI is a huge, huge bubble right now. It is an absolute disaster. I'm not saying AI as a technology. Like when internet bubble came out, happened in the early 2000, late 1990s, early 2000s, internet was there to stay because I was part of it, as I am part of it right now with AI. It's the exact same thing repeating over and over again. AI, artificial intelligence, is here to stay. It is going to be part of our lives. It is going to create a lot of jobs, but it's going to eliminate a lot more because of the productivity gains. Does that mean that AI companies now should be, say, 30 to 40% of the entire market cap? I don't think so. Does that mean that AI companies should be valued at 90 or 80% of the entire Nikkei 225? I do not think so. AI is in a huge bubble, and this Wednesday is going to be a huge, huge test when it comes to AI companies and their profitability and the hype that is around it. So if numbers, if NVIDIA beats the numbers, expectations, that great is going to lift tech sector, is going to take AI companies to the next level, and the bubble will get even bigger. But if they disappoint, because they are so huge in these indexes, is going to trigger a sell-off like you have never seen before. So as I said, NVIDIA's numbers, their print or their profit and loss is going to be the ultimate AI stress test this Wednesday. So as of today, it's like today, tomorrow, and Wednesday, very important. Also on Wednesday, we are going to come up with crude inventories. A big draw signals tighter supply, lifting oil prices and energy stocks. A surprise bill points to a weaker demand, rising supply, and the prices of these energy companies and the gasoline itself should go lower. So now, Thursday is coming, Q2 GDP second estimate. So now, the first estimate showed 3% growth, but much of that was due to falling imports, not stronger domestic demand. So the final sales to private buyers grew just 1.2%, weakest since 2022. So again, I believe that number, excuse me, will be revised lower. If that number revised lower, that'll push again a lot of pressure, stress on the Fed to drop the interest rates. Again, stronger revisions would reinforce resilience, boosting equities and yields. Softer number would push bond highs higher. Softer numbers would push bonds higher, weaken the dollar, and increase dovish pressure on Fed. Again, asking the Fed to uh, lower the short-term interest rates. So now we have the initial jobless claims also coming on Thursday. If the claims rise, it points to a weakening labor conditions, and again, it's a red flag for the Fed. If again they will be pressure to lower the rates. Claims stay low. That means there is resilience in the economy. Now, Fed will cover to hold rates, not actually lower them. Okay, Friday is a real showdown. It's absolute, very important on Friday. It is going to be the Michigan consumer sentiment preliminary print plunged to 58.6, which is lowest in the last 3 months. So inflation expectations 1 year at 4.9% and 5 year at 3.9%. Guys, their target inflation was at 2%. Right now, they're saying, okay, they want to bring it down to 3%, but again, I will keep repeating myself, they want to lower the rates. How are they going to achieve that if they want to lower the rates and they want to bring the inflation down? It does not work. The two do not go hand in hand. And the most important thing, it's very, very important for this Friday, that is going to be the July PCE inflation number. PCE inflation is different than the CPI inflation. PCE is the Personal Consumption Expenditure Index that tracks what households actually spend, including things like health benefits. And that is a Fed preferred inflation gauge. Core PCE, it basically strips out food and energy to show the underlying trends. So, okay, if you are, how much are you spending on long-term growth? How much you're spending on health insurances? How much you're spending on car insurance? How much you're spending on not food, not energy, but on personal entertainment? So those are the things that go into PCE. But again, if that number comes hot, that means if that number comes really, really high, then expect the dollar to climb. Expect yields to climb. Expect equities or stocks to wobble. A softer print is going to lift bonds, is going to give stocks a relief. Again, it's going to open the rate for an earlier, it's going to open the door for earlier rate cuts. So again, that PC, if it comes really, really, really low, Fed could actually cut rates even before the next meeting, which is on the 17th of September. So again, this week is very, very important. Again, next week is also important, but this week is going to give us a very good idea by Friday as to where things are headed with short-term and long-term interest rates. It is going to give us an idea where things are headed for um, the next meeting. And next week again obviously is going to be very, very important because it's first of the month. A lot of the retail sales, a lot of the employment numbers are going to be coming out. Again, that is going to be one big factor. But this week we have 3 or 4 different medium to medium to big size factors that are going to drive the Fed's decision per se. And again, something interesting happened today, or actually over the weekend. Let me bring this here. Okay, I hope you guys can see this screen. Can you guys? 1 second. Let me make sure. I think so. Yeah. So you are looking at the Bitcoin chart. It's a 4-hour chart, Bitcoin, and it broke its medium term. You see, from April till date, it broke that trend line very decisively. And right now it's trading at 111,972. So almost $12,000. It came down all the way down to $110,000. Now it's back to $112,000, but the trend line has been broken decisively. So that's something that we are following closely, because right now everybody is riding that euphoric ride wave on cryptos, especially since Trump came into power, and he is very, very pro crypto. And NASDAQ also is looking like still very toppy. Is not doing much. Is kind of going toppy and sideways. It's not doing much. Dollar is again taking a hit right now. EUR USD is sitting at 117 and change. Um, Again, dollar index is tad below 98, is not doing very good. So again, this week is very, very pivotal. It's very important when it comes to dollar, when it comes to interest rates, when it comes to markets, crypto. I think this is a week to monitor very, very closely. I think that said, that's everything that I wanted to cover. If anything changes, I will be the first one to let you guys know on our Telegram. If not, I will talk to you next day or so. Maybe if not tomorrow, day after, because tomorrow I am traveling pretty much all day. So tomorrow I won't be able to make it, but I will be back day after tomorrow, which is going to be the Wednesday. Okay, guys. So that said, I'll call it a day. You have a great day, and I will talk to you on Wednesday. Thank you. Bye.